Monday, October 26, 2020, Monaco 64, home of alternative economics and contrarian views. We're going to look at the FT today and the fake gold news it has published over the years. And in this case, I'm going to reference an editorial from 2004. And many of you probably know the story already. I've done this a few times. But as I get new subscribers and new viewers all the time, I find it interesting to revisit this. Not to forget that precious metals manipulation is not only price manipulation, but psychological manipulation. Eventually, though, the powers that be, the bankers, will let the price of gold and silver higher because that's the only way they can keep control of the monetary system. If they want to keep control of the monetary system, most people think that they control or own all the gold in the world. That's what they want you to think. And that's why they're so scared of people getting involved in gold, because official gold holdings makes up only about 17% of all the gold ever mined. For example, jewelry ownership is almost 50% of all the gold ever mined. So they don't want you or small investors to getting into gold and silver, especially physical. Yes, they push you the ETF, but the ETF is no substitute. So this story is back in 2004. I was still working in the city. I used to get up at 5 in the morning, get ready to go to work, get to the train station around 6 o'clock, get the 6:08 train. I used to buy the FT once in a while, read it on the platform. And I used to turn to the editorial page first thing. I always used to like reading the editorial page for some reason. And I came upon this editorial on gold. I'd been buying gold for 2 years in 2004. I'd been looking at gold, the history of gold, the history of the monetary system. That's what buying a few gold coins led me to do, to look really deeper into gold and how important it was. Before I got involved in gold, I had no idea. So let's go through this editorial. As you can see here, I was so shocked by this editorial, especially coming from the Financial Times. You'd think they would know better. They would realize what gold really was. So yes, I cut out the editorial, I laminated it, and I've kept it. And I've also got it as a screenshot. So as you can see here, at the time, the price of gold was at $400.65. So this is the propaganda here. Going, gold. The pointlessness of holding bullion continues to sink in. And by the way, I've got FT fake gold news mug in the Teespring store if you're interested. The barbarous relic, as Keynes called it, is crumbling to dust when even venerable N.M. Rothschild has quit the gold market, and the Bank of France, among the most stubborn of official gold bugs, is thinking again about its bullion holdings. The end of gold as an investment has come a little closer. It will not be before time. The fetishization of shiny yellow metal decades after it ceased to be used as the anchor of the international monetary system is a lingering anomaly in modern financial markets. Perhaps Rothschild's last service to the bullion market could be to keep a live gold trader on display behind glass as a reminder of a bygone age, like the former coal miners who now make a living giving tours of defunct pits. The one advantage of gold as a reserve asset is that, unlike assets based on fiat money, governments cannot make it worthless by inflating it away. That's true. But in an era of low inflation, and given that independent inflation targeting central banks are the norm across the industrialized world, that risk has very sharply diminished. I think they're completely wrong about that. Central banks now are working together with governments to inflate the system away. Indeed, for both private and official investors, gold is now a rather risky asset. With a nil or low return, the intrinsic value of gold determined by its use in various industrial processes is well below its market price. Gold does not grow, so its value to any one investor as an asset is dependent on other investors also holding it as an investment asset. The gold price hangs precariously by its own bootstraps. Just gonna pause here a second. You can imagine the people that were reading this back then, investment advisors, normal investors, any kind of individual, that would have put them right off from gold. It did not put me off. I realized this was propaganda. So let's keep going. For private investors to hold gold on this basis is their own foolish affair. For central banks and governments to hold it as a reserve asset is a betrayal of the public on whose behalf they're acting. I guess Gordon Brown didn't betray the public, right? Because he sold half of the UK's gold. Despite the recent sell-offs, government and central banks still hold about a fifth of the world's bullion. There you go, about 20%. It's a bit less now. Their large holdings relative to the size of the market by themselves make gold particularly ineffective as a reserve asset. The very act of official selling of bullion on any large scale to raise cash will itself drive down the price. Yeah, it's a complete fallacy, of course, because cash or promissory notes used to be a representation of gold, but the FT doesn't talk about that, of course. This danger was amply demonstrated by the UK's unhappy experience of trying to sell some of its gold holdings. Announced in 1999, I would say it was pre-announced in a sensibly open and transparent fashion. The sale sparked such a fall in the global bullion price that a group of central banks signed a concord limiting such sales. I would say that was more related to trying to save the bullion banks. The rumor was that Goldman Sachs had a big short and Gordon Brown did them a favor. That has recently been superseded by a new agreement providing for limited gold sales. Given the pointlessness of holding gold, the speed of its official sell-off scarcely matters unless leaching the gold into the market bit by bit somehow maximizes the return to the public purse by limiting the impact on the price. That would imply some irrationality on the part of the market. But then holding gold is irrational in the first place. Perhaps the central banks are right to go slowly. Whatever the speed, the direction is clear. Gold is on its way out as an investment and reserve asset. 3 cheers for that. So there you go. When I read that editorial on the platform and I got on the train, I couldn't believe it. Did it put me off having gold? No, because I knew there's something wrong with the FT. And I knew back then already that it was a globalist organization and that you couldn't trust it. So to all of those out there who are uncomfortable holding gold, who maybe bought gold and silver recently and are frustrated, you shouldn't be, because it's a long-term game. Gold and silver are not investments. They're money. And with what's going on in the world right now, with all the money printing that we've had in the last 8 months, and we're going to see even more, a deluge, I would say, very soon, a second wave, so to speak. Fiat currencies are going to lose even more of their value. And that's what gold and silver do. They don't go up in value. You just hold on to their purchasing power. It's the fiat currencies that go down versus gold. That's what you need to understand. So with that, let's quickly look at where the markets are this morning. It's 7:28 a.m. London. We're only 4 hours ahead of Eastern time right now. Our clocks went forward yesterday. So right now we've got gold down just over $2 at $18.99. Range has been 1891 to 1904. Silver is down a bit here. We're down 42 cents or 1.7% at 24.18. Low has been 24.08. The stock market, though, is having a tough time this morning. Dow futures right now is down 386 or 1.37%. S&P is down 1.32 at 34.19. NASDAQ 100 future is down 1.1 or 130 points. So the stock markets are under pressure this morning. I suspect that's why silver is down a little bit. And you might say that's not a little bit, but 40 cents these days is almost nothing for silver, I would say. I would say gold is holding relatively well here, almost unchanged. The currencies, we've got sterling down just over 1/3%, just below 130 sterling or cable. We got the euro down 1/4% at 118.29. The dollar's up 1/8% versus the yen at 104.88, and the dollar is up 1/4% versus the yuan at 668. So yeah, we're seeing a little bit of dollar strength here, but I wouldn't be concerned about that either for precious metals, because in 2008, the dollar index, for example, bottomed at 70.69. Gold at the time had made an all-time high at 1,031 or thereabouts. And now dollar index is in the 90s and gold is at almost 2,000. We might see these short-term correlations, but in the long term, gold and silver are going to go up, or the fiat currencies are going to go down versus gold, and that includes the dollar. Crude oil is down 3% at 38.60. So down over $1. So that's a fairly big move. We haven't seen that kind of move recently. To finish off, let's look at the bond market. Yes, bond yields are falling back here. We're back to that level that used to be resistance and now is a support. We're at 0.8% in the 10-year yield, down almost 4 basis points. So there you go. Don't get discouraged by the manipulation of the price, nor by the propaganda against precious metals, the denigration of sound money proponents. They call us, of course, gold bugs, but I don't really care. And believe me, one day they're going to have to go long the precious metals if they want to stay in control or have some semblance of control. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great start to the week. Take care. Bye.